Hey, what's going on, guys? Welcome back to another video. Today's video is going to be on order blocks and diving deeper into order blocks and finding out which ones work, which ones don't work, and a lot more. Yeah. So first thing, I just want to quickly apologize for not uploading recently. I've been really busy with school and other personal stuff I had to deal with, but I actually have a couple of weeks off from school right now, so hopefully a lot more videos will be coming out, so stay tuned for that. So let's get straight into this video. So the first misconception that people have with the order blocks is that you can only trade order block. You don't need to implement anything else. All they trade is, they just trade off of what they see, which is the order block here, and then when they buy and sell that at these random order blocks, they get confused on why it didn't go their way, and etc. So let's actually explain. Let's dive deep into why some order blocks work better than other ones. So just looking at this whole little bit of price action all the way from here, I want everyone to do a case study of what happened in the past to understand what's going to happen in the future. So right over here on the daily time frame, what I can notice is that there was this range right after the market rallied up. It created a range of support and resistance. So let me just do this X bottom and then X top. So we created this range of support resistance, and as everyone knows, these type of ranges are a manipulation of the lows and highs, meaning that these support, everyone who's buying these support touches over here, over here, all these support touches, they're just generating more liquidity to grab in order to go higher, right? So the market maker, the banks, the big boy players, they're basically generating liquidity, right? So the retail traders, every time they buy at these levels of support, that gets tapped multiple times, the weaker that level is going to get. So the next time the market touches that level, it's eventually going to break out of it and grab all the liquidity that rests below. So that's what ends up happening. The market takes that liquidity, and once the market grabs liquidity, it can do either one of two things. It can either continue going down and just sell off, or it's going to take that liquidity and then go up. Now in this case, it takes that liquidity, and you can see that there's a lot of buying pressure. It's still going up. And the reason that the market is going to go up is because there's still liquidity of the highs of the resistance traders. So every resistance trader that was selling over here, they created more liquidity at the top. There's a lot of stop losses that rest above that the market has to take out. So basically, this doesn't necessarily mean that, okay, buy right away. That doesn't mean that, okay, because there's liquidity here, buy. That just means it gives you an idea of where price is going to go in the next few days, maybe next few months. So you can see that basically price moved up from here, it goes up. Now if I were to extend this line, right, and we look at what the retail trader was looking at, by the way, when I say retail trader, I don't necessarily mean that I'm not a retail trader. I mean that from the retail trader perspective, strategies eyes, right, the retail traders that trade support and resistance, they're looking at this rejection right over here, and they're looking at this rejection as a sell confirmation to take that sell, because this is a level that's been tested multiple times. So this induces traders to actually take that sell, and when they take that sell, obviously it goes their way for a little bit, but then evidently they get stopped out. So this is why it's important to map out your equal highs and equal lows to understand where liquidity is. Now I'm going to dive deep into why this is an important level of structure. So overall, we just took the money, we took liquidity from the top and we're moving higher. Now the fact that we're moving higher, we took all the money and we're making higher highs, higher lows. This basically gives me enough information to know that long term I'm going to be buys on Euro USD, even though I might have a small little break of structure of this higher low right here. This doesn't tell me that I can look for sells now, even though you could technically start looking for sells. Well, me myself, I'm a long-term type of guy. I like to think long-term. I don't like to be in and out. I'd rather hold stuff for the long term and let my money / wealth grow from there. So because I know overall long-term on Euro USD, we've just been taking out the previous highs, making newer highs. I know that this move down, I'm expecting this move down. I don't need to capitalize on this position. Rather, I'll wait for this move down to be finished, and then I'll look for buy side opportunities. Specifically, I do this because there's a lot of manipulation that happens inside of this move. When the market is retracing and you're trying to enter on that retracement, you're going to see a lot of manipulation, a lot of confusion happen, and it's best to just stay out of those type of situations. So now it's time to map out my order blocks. And first thing first, before we start mapping out order blocks, I want to go explain what's the most important part in an uptrend. The most important part in an uptrend is obviously the expansion and the retracement, because that's how the market moves: higher highs, higher lows, right? Now obviously it's not going to look something like this. No market looks like this. Maybe on a line chart, but not in candles, right? But what I want you to understand is that inside of this expansion and inside of this, the finishing of that retracement, there's most likely going to be areas of interest inside of these levels. What I mean by that is, at the start of this expansion, you might find an order block, and at the finish / end of this retracement, you might find another order block, and so on and so forth. What that doesn't necessarily mean that you're going to be using every single order block you see on every single expansion and retracement. The reason I say that you can't use every single one is because the overall theology of how the banks trade is they like to buy when price is low and sell when price is high. So if price is this high, do you think that the banks are going to buy over here? No, most likely they're going to sell and buy when price is low. So if you see order blocks that are red over here or red over here, or maybe even over here, that doesn't necessarily mean that these order blocks are going to give you that 4,000 pip move that you're expecting. They may reject off of it a little bit and give you a small little 10-20 pip move, but don't expect something crazy. So let's go back down to the charts, and I'll give you guys an example. So right over here, right over here, you can see that there's a pretty clean last down candle before the move up that gave us a continuation of structure. I see. Let me just quickly change that. Alright, boom. So we have this zone right here. We have a zone of interest. This last down candle before the move up. You can see it comes into it. Doesn't really give you a nice entry. It just comes into it and starts moving consolidated, right? There's not much movement. And in an order block, when you have an order block, you don't want to see a lot of choppiness happen like this. Usually if you have an order block, you want to see price tap into it and move off it really quickly. When the market is doing things like this, where it comes in and it starts moving really choppy, this basically tells you that this level isn't too strong, right? A strong level isn't gonna wait for people to enter in on. It's gonna come into that level and move really quickly. Now, the reason that this order block right here didn't play out is specifically because there's no volume in it. And it's way too close to where price is at. Price was at right over here. Look, that's not a pretty big range, right? Like, sure, it's a 200 pip range, but it's too close to where price is at. So, like I said, banks like to buy when price is low, sell when price is high. This is way too close to the current market price. And secondly, there's no volume, right? Like this last down candle, there's a lot of wicks. And after the next candle, which was a really big candle, it was followed by a lot of wicks. We don't want to see those type of wicks inside of an order block. We want to see imbalance, we want to see volume, we want to see liquidity, we want to see multiple things before we actually take that buy. So if I look a little bit below, we can see a much more cleaner example. We have this last down candle before that move up towards the upside. Now the reason I like this one is because if you extend this line right here, this used to be a previous level of resistance, right? Where previous sellers in the market were looking to sell here. And like I said, this is that last down candle before the move up that actually caused this liquidity grab to happen. But because this is the cause of the liquidity grab and this is the last down candle, my main area of interest is going to be this daily order block. So what I like to do is I mark up the open of the OB and the low. And from here I just call this like my daily IC. I'm not going to dive onto the 4-hour time frame because by now everyone knows how to mark up your OBs. So I'm going to try to stick to the daily and the 4-hour for now. So the market, let's play the market. And one more thing, when you are marking up your order blocks, don't just look at this and ignore what's happening here, because what's happening here is really, really important to what's going to happen over here. For example, a lot of people might not realize it, but there's liquidity here, right? There's equal lows being created where retail traders are looking to buy at this level of support. This doesn't necessarily mean that this level of support can't give you trading opportunities, because you can definitely capitalize on movements from here to here. That's a really good 138 pip move. But me, as my style of trading, I like to wait for the market to manipulate the people that are buying the support that's been tested multiple times, and then enter off of that when everyone stopped out. So in this case, there's an order block below liquidity, and that's a really good sign. The sign is that if there's an order block below liquidity, that's a really good sign, because for most of the time the market takes liquidity, it takes that liquidity and then it goes up. So this is why this area of interest is much more valid. Now if I drop down to the 4-hour time frame, you can see that there's a lot of volume in this candle as well. By volume, I mean look at how big this last down candle was, and look how quickly it moved back up compared to right over here. You know, there was this last down candle with a lot of wicks. It did move up quickly, but then look how slowly it moved back down. You know, there's not a lot of volume compared to this situation. The market created this last down candle, and then it moved up, and there's a lot of volume inside of this area. So at this point, what you could do is wait for price to come into your level of interest, and boom, it taps into our level of interest. Play the next candle, and let's see if we get a trading opportunity. Now, some traders, they like to set limits right away, right, with the stop loss at the low, and they just buy right away, and that's fine. If that's what your trading style, that's fine. Me personally, I like to wait for a little bit more confirmation before I actually take that buy. So I would personally wait for a break of structure and then a retracement. So right over here, you can see that this movement down, I'm sure there's multiple lower highs that the market created. Let's go to the 1 hour time frame to see, and right here you can see the market created a bunch of lower highs that eventually it broke. Right here there's one, here's a second one, and then here's a third one. So we have multiple breaks of structures that does indicate higher pricing movement. So let's go back to the daily time frame. At this point on the daily, there's a clean OB right here. I'm sure you can mitigate this, or sorry, not mitigate, refine this on the 4 hour, but I'm going to try to keep this video short, so I'm not going to do that. Let's just say we're entering on the open of the OB, stop losses at the low, and you can literally just target the next high. It wouldn't look something like this, right? I'm sure we would have a much more better risk to reward ratio. Well, I'm just trying to give you guys an overall idea of how I enter on this OB and why we use this order block instead of this order block. The reason we use this one is because there's more volume in it. There's imbalance in it. There's it was below a level of liquidity, and it was, you know, it wasn't too close to price. It was in a nice it was a nice discounted zone. So that's about like 4 to 5 confirmations we had. So that was a decent, you know, trade right there that you caught. And overall, this is one more thing I want to say. Overall, we caught a pretty decent 196 pip move. One thing that people will tend to do is they will say that they'll set their take profit at somewhere high, like here, 389 pips. You have to make sure that you're targeting the next high. I'm not talking about this as your swing point high. I'm being literal. Target your next high if you're not too confident in the trade, because let's analyze the structure of what the market really did. It pushed up and it started moving down really slowly. Because it's moving down really slowly, we know that, you know, sellers are slowly entering in the market, and this signifies that lower pricing. The markets want to bring the price lower, and we also broke structure this, so this also does indicate that the market wants to bring price lower. So at this point, you wouldn't want to target nothing crazy, just target the next high that you see, and in this case, it would be right over here. So that's a good idea of why we use this order block. Now, like I said before, the most important part in a downtrend, in an uptrend, is the higher low and the expansion. Right over here, we can see we have a high, higher low, high, higher low, and then another high. On the daily time frame, on the 2 daily time frame, you can see that there's a really clean down candle before this huge expansion towards the upside. The reason I like this area of interest is specifically because there's a lot of volume in this level, right? If you go to the daily time frame, just off of the 1, you can see that it hit a really nice movement back down and a really quick movement back up. And I'm sure if you go down to the smaller time frame, you can find some type of imbalance inside of here. Maybe you could refine this even more, but like I said, we're going to stick to the daily time frame. So what confirmation do we have for this? Well, we have imbalance in it, obviously, on the lower time frame. We have a lot of volume in this order block, which we signified on the daily right over here. You can see that there's a really nice movement back down and then a huge expansion move back up. And the way the market works is fractal. It comes to levels that had huge pushes. So this is the biggest move that the market had, right? And the fact that we're breaking past previous structure, we made a high, a higher low, another high, and now we broke past this ultimately does tell you that the market wants to bring price lower in order to go higher. Because if the market didn't want to bring price lower at this point, it would have just reacted off of this order block and completely went up, but it didn't, right? So this is certain things that you have to understand and, you know, take account. Now, if the market isn't going to react off of this order block that much, it's most likely going to be reacting off of a different order block. So, and by the way, you wouldn't want to be focusing on this one or this one, because like I said, it's not clean. You want to be focusing on clean volume order blocks. So we have this, our higher time frame point of interest marked up, and from now all we're doing is just watching structure. What happened right here? The market created a low, and then it made purged that low and made a new low. Like I said, this is the market maker telling me that it wants to bring price lower. So all we're really doing is waiting for price to come to our area of interest, and boom, it comes in. So from here, let's go to like the 15-minute time frame. Let's just see what the market really did over here. Let's see if we could capitalize on any opportunities to enter here. So market taps into our area of interest and it's selling off. Now, one thing I want people to keep in mind of is, just because the market comes in your area of interest and rejects just like it did over here, this doesn't mean that it's going to go up. Make sure you're waiting for the proper market structure to form before you actually take that sell, or sorry, that buy, depending on where you're in the market. In this case, we have a low, lower high, low, lower high. The market is just creating lower, lower highs. Finally, we have this big push towards the upside, right? And like I said, the market is going to target the areas where it had big pushes towards the upside at. So right over here, we can say right over here, this is where the market had a lot of volume. Not only that, but it also gave us a break of structure right over here of a previous lower high. Now if you go towards the 1 hour time frame, I think it was, or maybe the 2 hour, so 3H. By the way, you want to use every single time frame you can. Yeah, the 4H. You can see that there's a really clean 4 hour down candle before the move up. Right, let's go back to the 15-minute time frame, and boom. So this is your 4 hour last down candle. This is where this started. Now if you go towards the 2 hour time frame, I think it was, you can refine this a lot better. There's a clean imbalance right over here that the market is going to tap into. So what you could easily do is have your entries at where the imbalance was, right? So let's go back to the 15-minute time frame and let's analyze what just happened. So let's go back up to here. So boom, it did tap into our 4H OB, which was somewhere over here, but then we noticed that there's imbalance over here. And if you check the 2H time frame, there's a second OB. So all we really did is we implemented imbalances, and we implemented market structure, and we implemented a higher time frame to the lower time frame. Now what am I noticing now? Well, I'm seeing that there's liquidity generating just like before. Right over here, you can see that there is equal lows being created, right? And after those equal lows were created, we also had our, like I said before, imbalance right over here. So equal lows above and below a higher time frame point of interest is really, really important. And not only that, on the 5-minute, look at this really clean OB. Well, that's besides the point. So at this point, all we're doing is we're waiting for price to purge the equal lows. So this could take some time, and there we go. So it purges the equal lows, and this is our entry right here. Now if you go to the 5-minute, I think it was, not bad, yeah. So if you go to the 5-minute time frame, you can see it tapped into a 5-minute order block. So an order block inside of an imbalance, right? And remember, the question was, which order blocks do I use? Well, this is a perfect example. This is a 5-minute order block inside of imbalance, on a higher time frame imbalance. So this definitely, and this is also below a level of liquidity. So this easily makes this order block 10 times more stronger than a previous order block. And this is where your entry would be. Your stop loss would be just the low. And now your TP can either be the high, or you can target like somewhere else. Maybe, if you're a swing trader like me, I would like have a crazy target like that and just hold it long term. And then let this play out. See how this plays out. As you can see, it moves up really nicely. Just go on the daily time frame, let this run. And boom, obviously take profit, got smacked. So I just want to quickly go over this one more time. We had our second daily time frame order block. Market came into our order block. From here we went to the 15-minute time frame. On the 15-minute time frame, all we did was wait for bullish structure to form. If I saw something like this happen where the market breaks structure, but I don't see bullish structure, and it does something like that, like this, we break structure but it continues going down, I wouldn't take the buy. I need to see proper bullish structure form before I actually take the buy. And in this case, we had that bullish structure. We broke structure, and then market created a high and then a new high right here. So we created a high, a higher low, and then a higher high. So this is proper boulder structure. We saw that there's liquidity here, and then we went on the 5-minute time frame, and on the 5-minute time frame there was a really clean last down candle before the movement up, and it was also inside of imbalance. And one more thing I want you guys to understand is that this order block was at the low, it was at the bottom of the expansion. It didn't happen over here, it didn't respect this order block, it didn't respect this order block. Because look, the criteria is there. We have the volume, it's really clean, the volume really clean, but it didn't respect this order block, nor did it respect this order block. It respected the order block that came at the low of where the expansion first started. And one thing that I myself do is I take my fib, I have my levels tool, and from the low of where the expansion first started and take it to the high. Now, if the order block is inside the 70, 78, or 88 percentage time frame, or not time frame, sorry, percentage percentile fib range, that's a lot more confirmation right there. If the fib, if the order block is somewhere like in the 80, 60, or 70, not 70, sorry, the 15 or 50, don't take it. Make sure it's in the blue zone, and that's when you take that entry. And as you can see, at this point the market just completely flew from there. And all this happened, all this, the cause of all of this was simply our daily time frame OB, which was right over here. So I hope you guys took some notes on this. Remember, the OBs that have the most volume, that have imbalance in it, liquidity, market structure, these are the type of order blocks that are going to be the most successful. And remember to trade with the overall trend, implement other things like market structure, liquidity, like I said before. And things like these is really simple. For me, I had some trouble with it, but after a while I slowly started to get a hang of these type of things. And yeah, so if you guys have any more questions, please leave a comment below. Yeah, like that's basically it. Thank you and have a good one.